Okay, we're going to go ahead and get started with our lecture for Unit 5. Our Unit 5 lecture covers Chapters 5 and 6, which talks about cash liquid assets and credit and credit reporting, credit cards. We'll go ahead and get started with Chapter 5. This chapter really talks a lot about liquid assets, which is basically the management of things that can be quickly converted to cash. That's the concept of liquid, things that can be converted to cash. And then how do you differentiate and choose between the alternatives for investment and interest that could be earning on these types of assets. Anything that is considered a liquid asset will typically be low risk and earn a very low rate of return. Which isn't necessarily ideal, but it is always good to have some form of liquid asset on hand. So the types of financial institutions that you could utilize when looking at liquid assets would be typical bank or deposit type institutions. These are going to be places that provide traditional checking and savings accounts. These could be large banks, credit unions, savings banks, which typically take deposits, but they don't issue checking accounts. And then there are some non-deposit type financial institutions that you could invest in as well, such as mutual fund company, brokerage firms, sometimes insurance companies. They could, with a certain deposit amount, offer you checking and savings account privileges, but also earn a very low rate of return and considered to be a liquid asset. So really it's about preference, personal preference there. One thing that you might want to keep in mind is how you're going to access your bank accounts, whether it's a brick and mortar building that you can go to, or if they're going to offer you online banking, which would allow you access to all of your balances, allow you to transfer funds, pay your bills, view everything. Typically places that offer online only banking and no brick and mortar buildings are going to offer you lower fees and higher rates of interest. So you really need to look at the financial institution that offers the services that you would want and need. Also maybe look at whether or not the institution is insured, either through the FDIC, the NCUA, or the SPIC. Other alternatives, or looking at the alternatives that are out there, a typical checking account, these are typically very liquid, safe, low minimum balance, convenient. They can be interest or non-interest bearing. It depends on the type and the financial institution you have there. Savings accounts typically aren't used for as many transactions. So if you have a lot of transactions, the checking account would probably be better. Savings accounts are also liquid, safe, earns a little bit higher interest rate than a checking account, but still not that very much. And they can be hard to access sometimes. Money market deposit accounts would be an alternative to a savings account. They are a variable interest rate as the bank takes that money and then invests it and then passes a portion of the return on to you. Typically does have checking and ATM access if you would like it. These are still FDIC insured and sometimes can offer you check writing privileges. The problem with these is that they usually have very, very high minimum deposit requirements, penalties for pulling money out, or overuse of the checking or ATM privileges. And then, like I said, the interest rates aren't really that high. CDs are also an alternative. These are seen as liquid assets if they are maturing, or if you get the money back within a year or less. They'll pay a fixed interest rate while the funds are deposited. They can go up to 30 years. But anytime it's considered liquid as if it matures in less than a year. Advantages here are they're safe. Once again, they're FDIC and NCUA insured. They're convenient. They're easy to buy. They offer a fixed interest rate that's higher than some alternatives, but once again, can have high deposit requirements, early withdrawal penalties, and then the interest rates really aren't that high, especially right now. Another option would be money market mutual funds. These are similar to money market deposit accounts, except for that you are the investor, whereas a money market deposit account, you give the money to the bank and the bank invests it. Money market mutual fund is something that you invest. So you pool your money with other investors into a mutual fund company and then into high liquid short-term assets or short-term debts like CDs, which are loans, and then you get an interest on that. The advantages of that, it has much higher interest rates than the alternatives, can have limited check writing privileges. These are not insured, so that can be a downside. They can have some fees associated with them, and they do have minimum investment requirements, and that the minimum would depend on the investment firm you're working with. And then the asset management account would be really a firm that offers comprehensive services, so checking, credit card, mutual funds, typically by a brokerage fund. The advantages, you could have everything at one place, a higher rate of return, very convenient. Disadvantages is they typically have higher fees and higher minimum investments, and none of those items, even the checking accounts there, would be insured. Next we have T-bills or treasury bills, whichever you want to call them. They're short-term debt that's issued by the federal government. They mature between 3 to 12 months. Advantages is these are seen as risk-free, as the government has always paid these items back. They're exempt from taxation, and the interest rates vary. Disadvantages, the interest rates right now are extremely, extremely low. Next, we have other savings bonds like educational bonds and I bonds. These are considered safe, low-risk products. They're also issued by the Treasury, so it is basically a debt instrument, you lending money to the government. Advantages, they're safe, affordable, tax-free, again, convenient. Disadvantages, once again, these ones are harder to sell, typically take a long time to mature, and only semi-annually compounding rather than monthly or quarterly. So when you're comparing these, you want to look at the interest rates that you're going to get to compare to see which one's going to earn you the most. You want to use the annual percentage yield, not APR, to compare. Also, you want to consider the taxes, whether or not it's tax-free or taxable. There's the formula for calculating that right here on our screen. And then safety, look at some of the deposit types and see if they're insured. The FDIC for commercial banks, NCUA for credit unions. Money market mutual funds are not insured. Some brokerage accounts can be through the SPIC. And then lastly, ultimately choosing a financial institution that is cost effective for you, convenient, has the safety that you want, and has all the features that you're looking for there. Some other types of checks or accounts or features that you might be looking for are like cashiers or certified checks, also money orders and traveler's checks. The features of these vary in terms of dollar amounts, how they're paid for, how they're backed, whether or not they're insured, so refer to your textbook for those. Electronic fund transfers are very, very popular now. Almost all financial institutions do allow EFTs, which are basically any electronic transaction that either pulls or puts money into your account. Typically, the transactions take place immediately. They're not deferred. Allows you to not carry cash or checks, and then you can pay your bills with it. So some examples of this would be ATM transactions. These are EFT transactions. All debit and credit card transactions. Smart cards, which are funds that are like debit cards, but from an account that's stored magnetically on the card. So it's basically like a store card, and they perform the same services as a debit or a credit, but the funds can run out. Also, store value cards would also be EFTs. These are what are known as single-purpose cards, which can only be used at one store and not a variety of stores, whereas a multi-purpose card, which could be used just like a credit card at any store, and you can put money back on it. So many of these types of cards have activation fees, maintenance fees, or like ATM transaction fees. So any card that you're looking at for the EFT feature, make sure you know that what fees are associated with it. Alright, let's move on to Chapter 6, which is looking at credit cards and open credit. Anytime you're looking at credit cards or credit in general, it's looking at receiving cash, goods, or services and promising to pay it later. So you're not paying for it now, you're postponing it to sometime in the future. Open credit is also known as revolving credit, which means that there's a certain dollar amount that you can tap into and pay it back over an extended period of time. Closed credit means that it's basically one time, like a car loan, it's a one-time credit. With any type of debt or credit, any unpaid balance at the end of the month is what accrues interest, and then that carries over to the next month. So you only pay interest on what's carried over. Higher balances on credit lines equal higher costs because the interest rates are typically going to be higher because it's more risky for the creditor to issue that much credit, and so on and so forth. The overall interest rates are generally stated as an APR, annual percentage rate, so it's the true simple interest paid over the life of the loan. Just know that there can be compound interest on this if you're not paying the balance off in full every month. All of the interest rates must be disclosed not only on the application but on every billing statement. You'll want to know whether it's a fixed or variable. So a variable can go up and down, a fixed will stay the same forever. And then teaser rates. Does it stay low for a certain period of time and then go up? Grace period is the length of time that you're given before you must make a payment and the interest is charged on the outstanding balance. Typically for credit cards, it's about a month, 21 to 25 days, but some credit cards have no grace period, so it's really important that you read the contract there. On any credit card, there is no grace period with cash advances, so those are more costly because of that. And grace period is canceled if there's an unpaid balance from the previous month. So like I said, anytime you carry over a balance, the interest starts accruing immediately. Other fees that you might want to look out for are annual fees. This is basically the cost that they're going to charge you to have the card in your wallet at any point in time. So some cards have annual fees, some don't. About 70% of the biggest credit card issuers right now don't charge an annual fee, so make sure that you're looking out for the other 30%. Other fees, cash advance fee, we already talked about. Late fees if you make your payment late. Over the limit fee if you go over the amount of credit that you have extended to you, and then a penalty rate. If you're late for so many of your payments or you haven't paid, then they can increase your interest rate, known as the penalty rate. What's best for you? You need to know if you're a credit or convenience user. Credit user is a person who carries the unpaid balance forward from month to month, so they're basically only making the minimum payment. Convenience user is a consumer who pays the credit card off each month to avoid interest. Convenience and credit users generally pays off all of the balance. It's a matter of how you're going to use it in the long term. Your textbook also talked about the 5 C's of credit: character, capacity, capital, collateral, and conditions. Character is just your overall, basically, willingness to repay the debt. Capacity is your financial ability, so kind of short term. Think of it, how much money do you have each month to pay back your bills? Capital is looking at your total financial holdings. So net worth, basically. Collateral is if you're putting any assets up against the debt. So if you do not pay something back, what are you going to give up instead? So what are you going to allow them to seize, to sell, to make good on your debt? And then conditions are the overall market conditions, which will help dictate the interest rates and the terms on the product. Let's shift gears here a little bit quickly to the credit score. Credit scores and credit reports are issued by credit bureaus. These are companies that gather information on your financial history, including payment history, debt limits, that kind of thing, and then sells it to consumers. Credit bureaus compile all this information and then issue the report and the credit score. So each credit bureau is going to have slightly different information, and so you're going to always see slightly different items if you get it from multiple sources. Your credit score will affect basically what you pay on your debt, how much debt you can take on. It can also affect insurance rates. It's been statistically shown that those who have a lower credit score are more likely to file an insurance claim, so they can discriminate based on that fact. And then a strong credit score, so the higher the score, the lower the interest rate and the larger size of debt you're going to be able to get. Your credit score is based on general models developed by the Fair Isaac Company, which is also known as the FICO score. However, each credit bureau has a slightly different formula or model. So when we're talking about the FICO score, we're talking about general models here, and everybody's going to have something slightly different. So with a FICO score, your scores range from 300 to 850. You see the link there for a credit score estimator, which you can use for free, but it helps you get an idea of where you stand. Let's switch gears here. Yeah, let's show the pie chart for the credit score first. So your credit score is weighted based on different factors. So the FICO score is going to be weighted 35% on your payment history, so if you made it on time or if you were late. 30% is the amount that you owe, so this is balances on each debt, and then total debt that you've taken on. So as individual accounts and then as an aggregate. 15% is the length of credit history, how long have you had those credit accounts open, and then 10% is each assigned for types of credit used in new credit. So whether you have an auto loan, mortgage, credit cards, and the new credit is how many new accounts you've had open in the last few years. So this is generally how those items are weighted So if you're looking at improving your credit score, you really need to make sure that you're making your payments on time and you're paying down the amount of your debt. So pay your bills on time and pay more than the minimum balance. Credit score is kind of a secondary thing. Your credit report tells you the activity, and then that activity is then used to develop a credit score. So if you're going to influence something, you need to work on improving your credit report first, which will then impact your credit score. So what's in that credit report? It has 4 main categories: your identifying information, which is like your name, your address, employment history; trade lines or credit accounts, or the history for the individual debts or accounts you've had open; inquiries are the people or companies that have been looking at your credit in the past couple years; and then the last category is public record and collection items. So if you've been sued, if you have any items that are put in collections, those are listed there. So when you're reviewing all of this stuff, you need to check for errors. Not only, typically you'll find these in your credit report, but they'll impact your credit score in the long term. To check for errors, make sure you get your free copy of your credit report from annualcreditreport.com. You can get 1 copy of your report from each of the 3 major credit bureaus once every 12 months. So those bureaus are Equifax, TransUnion, and Experian. And you'll want to make sure that you pull 1 of each company every year because, like I said earlier, they have all have slightly different information. You also need to know your rights. So the FACT Act is the one legislation that provided you the 1 free copy, which also says if credit bureaus must investigate and correct it if it's inaccurate. You also are given a statement, so many words to explain negative information that must be there. Fair Credit Reporting Act also says that negative information will only stay on there for 7 years for typical information and then 10 years for bankruptcy. So all items will fall off eventually, but it's 7 years at the earliest from the last date of contact. Also use that credit report in the dispute for identity theft. So identity theft is just the use of any of your personal information by someone other than you without your permission or knowledge. And they use this to commit fraud. So use your credit report and your credit score to make sure that you're monitoring that. You might recognize being a victim of identity theft if you've received a credit card you didn't apply for, receiving letters from debt collectors, or just billing statements from companies you don't recognize. If you've been denied credit but you think you've had a positive credit history, might be something to look into as well. So all things to keep in mind and watch out for there. If you find that you have been a victim of identity theft, first you want to put a fraud alert on your credit file, which is going to freeze all credit that would be extended to you under your social security number. So anybody that wants to open new accounts wouldn't be able to do so. You'll want to make sure that you close any accounts that have been tampered with or you didn't open. Ultimately, file a police report. They won't be able to pursue the person or persons who have committed the fraud unless you file a police report. Sometimes they won't be able to find them, but if they do, you need to have that police report on file. And then ultimately file a report with the FTC. Sometimes they can kind of lump these cases together and go against them federally if it's across state lines and that kind of thing. That's it for chapter 5 and 6, unit 5. I hope you do well on the quiz, and I will talk to you next week.